Hey, it's Pete. In today's option trading lesson, John's going to show you how to create passive income using a strategy known as the poor man's covered call, which is different from a straight up covered call. In this case, you don't need to own the stock. He's also going to cover three main mistakes that options traders make that are easy to fix, but you probably don't even realize that you're making them. He's also going to get a little bit into trade management, the key differences between John's approach to trade management and portfolio management that's very different from that of a typical retail options trader. And finally, John's going to go over the key considerations that he uses when deciding whether he should tighten up a trailing stop loss on an options trade or just flat out exit the position. Enjoy the video. If you have any follow-up questions, make sure you leave them below in the comments. We'll get back to you as soon as we can.
Those are kind of like the directional things I'm going to be looking to do, where I'm going to try to balance out my basket.
Even if we're balancing out the basket, John, before you mentioned, I'm going to start looking for a little bit of shorts or something for the other side of the basket. Just so everybody's clear, we're not giving that equal weight as far as capital allocation. I mean, the market's just way too strong. We're basically looking to start initiating trades on the other side, but certainly not bearish at all.
Definitely not. So yeah, I mentioned bearish a couple of times, but I'm not bearish on the market. What I'm doing is I'm offsetting my bullish portfolio by adding a couple of bears, expecting sort of a sideways to slightly weaker market this week. And hopefully, hopefully my bulls will hold up and they won't get stopped out. They'll still be around, but I'm not expecting miracles out of them. So what I want to do is add a little bit of bearishness, especially in the underperforming groups that we mentioned, just in case we get a little bit of a pullback. If that happens, those sectors will probably underperform the market. They'll be even worse, in other words.
So I want to talk about actual tactical implementation of that, because it's very common to stay at a higher level. So I'm just going to use round numbers, everybody, just to keep the math simple. Let's say you got three longs and they're profitable, and then you put on one short. So you got 25% or whatever the math, that's 25%.
Yep.
And let's say the market, and let's say the three longs do go down, but the bearish stock goes down as well. Are you using the profits on the, and again, we're not anybody's financial advisor, we're talking about education here. Are you using the profits on the short sale or the bearish trade to hold the longs that are pulling back?
I don't look at it that way. So that's a good question.
It's a question we get in coaching all the time. How do I manage?
Yes, I'm managing a basket. So let's say, to keep the numbers simple, like you said, I got three bulls going on. They're doing fine. Life is great, but they're not at my target yet, but they're in the money. They're green, for lack of better words. And then I put on a bearish trade, and that's doing okay too, because the market's kind of going sideways to down. What I will do is, my exit strategy is fairly straightforward for all my trades. Those bullish trades that I have on, if the target's not reached, I'll stay in them, but has the edge disappeared? So I look at, again, I pull up two charts. I'll pull up the S&P or the NASDAQ, depending on what group it's in. And I'll pull up the individual stock that might be in question. And I'll say, has it performed? Is it doing what I wanted it to do? Has my edge in some way disappeared? Is the justification for the reason why I got into this trade in the first place, is it ending? Is there, is it breaking trend? Is it not, did another piece of news come out? Did anything happen between now and like a couple of days ago that makes me not okay? You know what I mean? With that particular name. I don't try to make things up. I just look at the charts and I make that determination. If nothing's really changed, if the stock is just languishing like the rest of the market is, I will stay in that trade. And the reason why is because I have no idea what the future is going to hold. I don't know if the market's going to languish another week, or if it's going to just take a break and rip to the upside again. So why would I get out of something prematurely? You know what I mean? So it has nothing to do with the bearish trade that I'm in. The bearish trade that I'm in is a separate animal completely, although it's in the context of the basket as far as allocation goes, as far as how many bulls and how many bears I want to have. The bearish trade I will stay in for the same reason. Is it working? Is it doing what I wanted it to do? So I have a hard stop, obviously, which is my first and my hard exit, right? But then if I'm kind of deciding to hold on to things or not hold on to things, I would rather add bearish exposure and keep my bulls than to try to get rid of my bulls prematurely, if that makes sense.
No, it makes perfect sense because I think what happens is a lot of people think, and that's why you actually gave a great answer. It's not that you're not holding the longs using the short, profitable short as an excuse to hold the longs that are no longer doing what you want. You're actually managing all of the trades independently as you planned to before the trade started. And if the market happens to go down, again, using generalities here, you can get stopped out profitably on a trailing stop on your longs, but now you have a short that's profitable in the other direction at the same time.
Right. If the market rolls over and the edge is gone, I will take them all off. And then I'll be left with just bears. So then I'll be like, okay, well, do I really want this? I might then use the pullback to find new bulls. So I'm always thinking in terms of, okay, well, how bearish or how bullish should I be? And then I drill down to each individual trade and see how the edge is performing.
Hey, Pete, I just wanted to remind you that if you enjoy these videos from myself and John, we're actually going to be teaching a 6-week stocks and options program, but it gets even better. It is going to be our Black Friday offer this year, so you want to make sure that you get on the waiting list, and you can do that by clicking the link down in the description. I promise you, we will over-deliver. It's stocks, options, coaching, alerts, and can't wait to introduce you to the new AI program that we have for both as well. Click that link in the description. Make sure you get on the waiting list. We'll speak to you soon. So we got two good questions here on trade management. Chris is first asking, if it's languishing, would you tighten your stop loss? Chris, could you give a little bit more detail? Are you talking about a stock or an options? Because
with options,
it's a little bit different. And I guess both of these questions really, are we talking about stocks or options? Chris and Frank, if you just, I think that we're talking about options, but I just want to be clear on the answer. On the equity side of things, if it's languishing, we'll typically still hang on to that trade. The only reason I would get out is if the market conditions changed to remove that part of the edge away. So let's say I'm long a stock, but the market had a dramatic move in the other direction and the stock just really hasn't moved yet. I would probably move my stop up, but I wouldn't actually get out of any of the trade because in that case, it's still valid, but something changed. So I'm gonna manage risk a little bit differently. But this question here about managing a stop loss when a trade is going up, it's no longer a stop loss at that point. If it's a profitable trade, now it's a trailing stop. It sounds the same, but the language matters. Stop loss is you buy here, your stop loss is down here. Actually, let me get that off the screen. Stop and entry and stop. But now if it's moving in our favor, now it's a trailing stop loss. And Frank, I don't know if you've gotten on the on that part of the modules on the option side of things, but John, you spoke last week about your stop is based on the premium, not based on the underlying stock.
Yes, there's two ways to pretty much leave a stop with options, but I do it as a premium percentage. That's my preference. There's too many moving parts with options, in my opinion, to look at the underlying stock and say, well, if the stock goes here, then I'm getting out. I mean, you could do that. That's fine. There's nothing wrong with that. I want to be clear about that. But for me, I like to mathematically kind of measure my risk reward and everything else. I just use a percentage of premium. So usually between 30 and 50% premium loss, which allows you, usually 30% is maybe one ATR or two, depending on how volatile the stock is. And that allows you to sit in the trade for longer. So I just manage my positions in a way where I'm comfortable losing 30 to 50% of what I put down at any given time. That is a hard stop, Frank. Now, again, going back to the edge concept is when it's languishing. That's what we were talking about. Again, that phantom gray area where the stock is either losing the option strategy is losing a little bit of money, or it's making a little bit of money, or it's kind of flat and you don't know what to do. Then you have to look at your edge and you have to say, has anything changed since I got into this trade? Has the environment changed? Has the sector changed? Has something changed with the stock chart that I'm looking at? And if the answer is yes, then you might consider reducing your position and reallocating your capital into something more productive.
What would be a scenario where you would choose between 30 and 50%? Because that could be a significant number.
Yeah, that's a great question. Usually straight calls. I'll do, it depends if it's a shorter term trade where it's a momentum situation, or if it's a very, something where I'm kind of plan on only being in it for a short amount of time. I would probably have a tighter stop on something like that, like 30%, because it'll tend to be a larger position also. So that's another reason I don't want it to be, I don't want to lose too much money. Obviously, I would tighten the stop. Something like where the market's fairly volatile, the stocks are swinging around, and we don't know what's going to happen. I don't want to get out of something too soon. Like a vertical spread, or from a two-leg strategy, I prefer the 40 to 50%. And that's pretty much it. If it's a more speculative stock, the more volatile the stock is, the higher implied volatility it has. I would prefer to have a 50% because it's gonna bounce around a lot.
John, do you think in your experience that one of the bigger mistakes that options traders make is they hold too long for something that's not working? They're just allowing the time decay to eat away at hoping something happens?
I think the biggest mistake option traders make is they pick the wrong strike and the wrong expiration to begin with. They speculate on out-of-the-money options with a 1-week expiration, thinking that the stock's going to go to the moon. And if the stock does nothing, they lose everything. And they don't realize why they lost everything. They're like, well, why didn't I at least get half my premium back? Well, it's because you ran out of time. You know what I mean? So that's the biggest two mistakes I think option traders make. As far as holding on to something for too long, that's probably the third largest mistake, I would say, because what they're doing is they're hoping for the best and they're running out of time again. Time is your enemy when you're an option trader. Now, it could be your best friend when you're a credit trader, but it is your enemy when you are a long call buyer or a long put buyer. You have to make time a major consideration. So if you have a 1-week target on something, you need to go out at least a month, because you want to have a longer runway. If a pilot is trying to land a 747 and it takes them 1,000 meters, I don't know, to land a plane, do they look for 1,000-meter runway? Or do they look for the 10,000-meter runway? You know what I mean? It's kind of the same concept, because you don't know. Maybe you're gonna have to sit in this thing for longer. Look at CFG. You know what I mean? I had to sit in that thing for 2 weeks before it popped. You know what I mean? Because I thought it was gonna move with the financials, and it didn't. And I was losing money every day on that sucker. You know what I mean? And it was frustrating. And I was going to bail out of it, actually, because it was getting close. I was like, is my edge gone? Is it not gone? With the moving averages, it really never broke the moving average, maybe just once. And it actually closed above the moving average. So I was like, oh, I'm going to stay in this thing. Look how it just kissed the moving average. So like, to me, it was like almost, it was like, should I? The only thing that made me stay in it was that, the 20 was above the 50. It did kind of crisscross there for that one day. I think that's when I actually got in the trade, when it confirmed back to the upside, when it crisscrossed there. And then it just kind of bounced again a second time before it made that move higher. Super frustrating. And you got to that's where judgment call. That's where you got to say, well, so the reason why I stayed in it personally was because it was a small position. I was a long call. So I was like, going to the election, I'm going to cut everything in half. So I was just not fully risked. I didn't have like a lot of risk on. It was a nice return, but I didn't have like a huge position.
So just to be super clear again, I like things to be actionable. So while it's sitting in here, are you looking at how much premium you might or may not be down at that point as your stop, plus you're adding in the technical support that hasn't been broken at that point? So both of those going into the decision?
Yes, I have a hard stop of 40% or 50%, whatever it was. And I basically said, well, as long as it doesn't break that, I'm going to stay in it, because, right now it's basing. It hasn't really confirmed to the downside either. So I'm just going to sit in it. That was my decision, because the markets are overall bullish. So my decision is going to be based on, what is the market telling me? Has anything changed in the markets? No, we're bullish. So why should I get out of something that's bullish when the market's still bullish? Unless I get stopped out. That's a whole other story. Hard stop is a hard stop.
Well, that's actually answering Chris's question here about how do you know absolutely when it starts working against you. If you're long, you just answered that. That's the premium percentage. Yeah.
Or if the market itself rolls over. What I mean by roll over, if we close below the moving averages, if the sector itself, if something happened in the financial sector where it just kind of rolled over, that would be a red flag. You know what I mean? So picture this. The best way I could answer that question, Chris, is like, if you're in a sailboat and you have 3 sails, right? And you're in the middle of a pond, and you have the market is one sail, the sector is the other sail, and the stock that you're in is the third sail. If all 3 sails are in your favor, that's ideally what you want, whether you're long or short, right? If one of those sails gets ruffled, if something happens, then you got to start to wonder what you want to do. And then you make decisions based on that.
So again, keeping it back to like actionable, like people are like, well, how do I know? Like, is it still valid? Is it not valid? It really comes down to, you have to ask yourself, did anything change? Did the reasons I get into the idea change? And You don't necessarily need to bail out of it as soon as something changes, but you better sit up in your seat and be ready to make a decision. Maybe move up your stop a little bit more, maybe reduce your position size, but you need to ask that question.
In my case, I'm more apt to reduce as opposed to change my stop.
I do the same thing because even if it changes a little bit, and I love the idea, I still want to have it in my position summary to know if it catches a bid again and I could stay with it.
And with options, it's just trickier because it's harder to get in and out of things. You have wider spreads. So to like change your stop, I mean, that's like a stock trader's mentality to change your stop quickly and adjust quickly like that. And that's great.
You can get in and out at a much better price than you can with options. I could literally get to the penny. That's one of the things that I find most frustrating about options trading is I don't have that same to the penny in or out. The spread's going to be crazy.
Which is why I just have a hard stop and I let it be. You know what I mean? I'm already position sized for maximum loss. I know what my maximum loss is going to be. Maybe not to the penny, but close to it. And like with wide spreads, you know, if you have a 40% stop loss, you know, you have to allow for crossing the spread. You have to say, well, if it's going to cost me 10 cents to cross the spread, then I need to change my stop price. And that's all part of, you know, just, you know, risk management.
And there you go. That's the number one thing. You want to be in this business long, like Frank is saying here. Risk management is job number one. If you don't have risk management, you're not going to be around long enough to learn trade profitable management. Yeah. That's the other way to put it. You're not going to have any capital.
Yeah, I mean, it really, you know, the name of our company should be Risk Management Pros, but that's kind of a boring title.
And too long. We'll get people complaining it's too long to type in.
Yeah, I mean, that's really what we're doing because the money, like I always joke around, the money shows up, the profits show up. But if you manage your risk, the byproduct is what's left over is your money, right? If you've got stopped out of all your losers and you're managing risk and you're tightening things and you're making sure that your edge is there, even though you're not sure, but you reduce things, what's left over is your good stuff. You know, that's it.
What ideas you're looking at for next week, John?
Well, on the bearish side, like I said, GEHC, Merck, Moderna, Newmont Mining, HCA, IQV, Nasty. That one looks good because it just did a little bit of a bear rally. I like that good entry point there because it rolled back over that high. Said nasty upper shadow there, whatever that was. That's what I like to see. So that's something I'm going to look at. On the bullish side, I like Amazon.
Sitting near all-time high still, right? Or kind of perked up near it.
Yeah, I mean, high tight base. Now check this one out. This is rare. This doesn't happen that often. Check out CSX. Now expand it, make it bigger. I want to show you this cool chart pattern. Oh, yeah, make it, yeah, perfect. Check out that is called an island reversal. You see how it kind of went up and then it gapped down. It based like forever and then it gapped up. So usually a nice island reversal pattern, it probably, you know, the logic is it won't test that gap. It'll just keep, you know, kind of drifting higher. So again, that's in the industrial sector, you know, and we'll see how that plays out. I'm not expecting miracles out of that one, but I just thought that's a really cool thing you don't see every day. I wanted to point it out to you guys. An island reverse, you know, kind of like an island reversal.
Big bearish gap followed by a big bullish gap.
Yep.
So I have a lot of the same stocks, but probably still looking. I'm leaning a little bit more into some of the real estate stocks, the residential construction stocks, which were really, really strong for a while. When I start to see multiple bearish gaps, that generally has my attention.
Yeah.
I know it's on the bullish side of things as well, but residential construction, healthcare, I'm looking into a little bit. Dollar Tree and Dollar General have just not been able to catch a bid at all. They've been kind of hanging out while the market's been ripping to the upside. I kind of feel like if the market's going to pull back, these are two stocks, they're going to see a little bit of a stronger push to the downside. We have spoken a lot this week about asset management companies. I believe it was Robert, actually, who asked the question before, looking at KKR last week. So we do have a few stocks that are still on the bullish side of things that are looking good, as well as the airline stocks. I'm not sure I've traded where the airline stocks have been this strong for this long. UAL, DAL, even ALK a little bit. Morgan Stanley getting back into financials a little bit. We had a bullish gap, pullback, and now a bullish U-turn on Friday in Morgan Stanley as well. So I actually have a good list on both sides of the market heading into Monday, and what promises to be a much lighter week on economic data, and also a much lighter week on earnings as well. There's not a huge calendar on earnings this week coming up either, so should actually be a pretty good week to trade two-sided.
Yeah, I like Lululemon had a bad day on Friday, but it's still an early stage uptrend, which I like. I like to see early stage uptrends with high potential, going into the holiday season. I think this one might, if you look, it's, we've
been tracking for a while, finally broke this downtrend.
Yeah, it had obviously a nice big pop election time, and it's been pulling back. But let's see. This is one I want to wait for confirmation. I want to see how it behaves when it goes back to that 20-day moving average, which is around 300. So, we'll see.
I'm just kissing the uptrend here on Friday. I didn't even quite get there yet.
This could be a poor man's covered call candidate. That's another thing we talk about where, you don't expect miracles out of it, but it's in a slow, early uptrend where the worst is behind it. Let's say it's, the damage is done, but it's now in an early uptrend and you think it's going to kind of gradually drift higher. Those are really good poor man's covered call candidates. One
stock I have not traded in a while, but it's interesting to me this week is Disney.
That's another thing.
Banging our head against this resistance of around 98 for a while. We actually had a bullish gap, still relatively close to a good entry. I'm going to be watching that one this week as well.
Yeah, that's another one where you could make a case for a longer term play, like a poor man's covered call for that too, because it's clearly, the worst is kind of behind it. And even if it kind of meanders a little bit, you could sell some premium.
John, for the new members, can you explain what a poor man's covered call is?
Well, it's a great strategy. So a covered call strategy is when you own 100 shares of something in your portfolio and you sell calls against it to generate a monthly income. And you have to be okay with your potential. Your risk would be for your 100 shares to get called away, your strike price. So you always have to be comfortable with what strike price you select as your short call option, because if it does hit that price, you'll lose your 100 shares. So it's a little bit of a bearish strategy in the sense that, you have to be comfortable losing your 100 shares, right? But in the meantime, you could do that every month and collect an income. The reason why poor man's covered calls gets that nickname is so instead of spending money on 100 shares, which could cost upwards of whatever, $10,000, $15,000, $20,000, depending on whatever it is you're trading. A poor man's covered call is where you buy a leap instead of 100 shares. A leap is a long-term call option. So you go out a year, 2 years, a year and a half. You're basically renting the stock for a year is essentially what you're doing. And now theta decay is minimal because you are going so far out in time, you're losing very little money. It's like buying a big ice cube instead of buying a little ice cube. So that's like the best analogy I could give you. And what you're doing is you do the same strategy. You sell covered calls against the leap instead of selling covered calls against your 100 shares. And why would you do that? Well, the leap is going to cost you about 1/3 the price of 100 shares of whatever it is you're trying to buy, maybe even less. So your return on investment is a lot greater, but you have to have rules. So follow my videos and you'll see the rules. But basically you want to make sure you have rules in place in case it rolls over. You don't want to sit in something that's underwater. So you have to have rules. But it's a great strategy for smaller accounts who want to generate passive income. So, you don't have to babysit something like that. It's basically like you own something that you're going to hold on to for a year.
It's like you're a landlord.
Basically, and you just collect premium every single week or every single month.
So you bought the house and you're renting it out. In this case, you're buying the leap and you're renting it out.
Basically, yeah. So it's a cool little strategy. But, again, as it gets close to expiration, that theta decay is going to start kicking in. So you got to have rules. You got to get out maybe a few months before it expires, and you want to roll it maybe. There's strategies behind it, but that's the basic logic of it is you get the same return as a covered call without the capital needed, basically.
So it looked like you had a pretty good options call the other night. I want to make sure I specifically speak to everybody who's in the options program right now, other than the 3 fire alarms you had or whatever that was.
Oh my God, it was actual a real fire. That's what
Oh,
that is.
I didn't realize. I edited it out of the video, and I'm like, what happened? What was going on there?
I thought it was a fire drill, so I kept putting the thing on mute because I don't want to blow people's eardrums out. But I was dying; it was so loud. And basically, long story short, it was a real fire. There was like fire trucks outside and everything. So no one was hurt. It was just, something went on the staircase. Someone maybe smoked a cigarette or something. Who knows? But one of the alarms did go off.
So speaking to everybody who's in the options program right now with the coaching calls coming up, based on the questions they're asking, John, are there any gaps of stuff that they probably should be asking, especially if somebody's a newer trader, or any particular questions that got asked the other day that were really good that maybe you just want to recap?
Yeah, they were really good, a very diverse group of questions. But I think one thing that sticks to mind is, and this is typical of when you're new to this, and I think, Pete, you could agree with me on this. Everybody is asking about individual stocks. They're asking about like, oh, what do I do for this? What do I do for that? What I like to try to impose on people immediately is not one single trade or stock matters. You have to look at the markets, the sectors, and what you're looking at, the individual stock, and come up with that portfolio or basket. And that's really what allows you to kind of not, be able to sleep at night, so to speak. You know what I mean? And that takes a little bit of a transition of a mindset, I think, from a portfolio perspective, as opposed to an individual stock perspective. So I would love to see more questions on asset allocation, risk management, portfolio management, as opposed to individual names. You know what I mean? Because I don't know what the stock is going to do tomorrow. I could give you a million recommendations or alerts and stuff like that, but they could all go in the opposite direction. We don't know what the future is going to hold, and we do the best we can in context to what the market's giving us, and that's the key. But a lot of good questions about like, how do I place orders, or how do I place stops? A lot of technical questions like that. Again, everybody's platform is going to be different. So I encourage everybody to spend a little bit of time learning your platform, asking the right questions with your broker, making sure you understand how your platform works. But on top of that, just understanding how our whole process works from start to finish.
So I think you just kind of touched on the difference, I believe, in my experience, especially having been a prop trader for as long as I was. The difference between professionals and retail is professional traders, it's very common, whether we call it a basket or portfolio, a large group of trades. It's very common in my firm and any firm that I traded at, where you would see somebody's P&L and they'd have 20 to 25 open positions. Number one, and again, before we get into buying power and all that kind of stuff, even if with a $10,000 account, you can still have a bunch of positions. So let's
Easily.
So I think one of the biggest differences, it's a strategic and tactical difference, but also a mindset difference, is retail traders tend to bet the house on one trade, and professional traders don't put themselves in that position from a risk perspective and from the amount of positions they have on at the same time perspective. And I think that's a really big thing for people to think about.
Yeah, if your account size is small, trade one share, trade one contract, whatever, but have 10, 15 names is a lot. I know it sounds crazy, but that's a lot safer than to have one or two.
Yeah.
And don't trade the same stuff all the time. Like, we go through this analysis. We spend all this time on a Saturday going over sectors, going over what parts of the market are good, what parts of the market are bad, where to take that 10,000 share stock universe and put it down to 30 or 40 names to kind of just have a watch list for the week. Just that watch list is going to change dynamically every single week. Now, there might be some of the same usual suspects on there for a couple of weeks at a time, right? But over time, that list is going to dynamically change. And that's where the magic happens. That's where you get the edge. That's where you're in the right names at the right times, both on the long side and on the short side.
I think that's really where both of our research comes in handy. I think that if you're not reading it now, really listening to the thought, because I know that we kind of do the same thing, John, where we're trying to get our thought process into the newsletter so that we can help people to start thinking along those lines. It's so much more than just alerts. It's actually the thought process that is ultimately leading to those alerts. And we want to try and pass that structure, that thought process along to everybody, because it's more than just about tell me where to get in.
Yeah, absolutely. So don't just read the newsletter for the trade ideas.
Exactly.
Because then you're missing the whole point, you know.
Right.
And I challenge a lot of you. One of the things I challenge people during the coaching call was, listen, when you're setting up a trade and you don't know whether to go debit or go credit, for instance, why not set up both of them? Why not, you know, if the you know, if you're not sure which one has the best risk reward profile for what you're willing to take, and so on and so forth, take your paper account. Most brokers allow you to have a simulated trading now, so you could open up your paper account and put together both of them at the same time, side by side. Do the extra work and place the order and see how it behaves. See how a straight call behaves versus a vertical spread. See the difference in swing in your P&L, in your paper account, not your real account. And you know, see and feel the difference. You know what I mean? And you'll see what I'm talking about. Trading with the right strategy is so important. You know, with options particularly.